Yeah, I think the main takeaways from the presentation today are about all the active choices and decisions that go into the development and deployment of systematic strategies, and the fact that they are often hidden from the end user by claims of some sort of statistical objectivity, which I would make the case is often not appropriate. So if we are more open about the beliefs that go into designing these strategies, it also becomes a lot more natural to adapt them over time as market conditions change. I think first and foremost it's about the idea behind a particular strategy, if there's a particular effect that's being exploited and what perhaps the economic rationale behind it is, in addition to just seeing the data over time confirming that yes, indeed, there might be an effect. But I think generally we just don't have enough data to be ever statistically certain about anything. What we can do is we can develop beliefs about effects that can be exploited by systematic strategies, and then as we observe data coming in, get more comfort that indeed we are on the right track. So I think it is about this approach of story first, of having really a good rationale behind a strategy, rather than doing it purely data driven, where you kind of derive the story after the effect of having tested a lot of different strategies. Yeah, so the question of adaptiveness is a very difficult one because it very much depends on the type of statistical framework that one uses to judge a strategy. So I would say the two main competing frameworks are really one of what you might call a frequentist framework, which is all about counting events over time and then refuting some sort of hypothesis about the profitability of a strategy. And maybe the competing approach is one where you would take what's called a Bayesian approach, where you view things as requiring an initial belief, what's called a prior in the mathematical statistical sense, and then updating that belief as you go along, both with observed data as well as with perhaps structural changes, as well as ex-ante measures of valuations or carry, etc. All the information you have to gradually change your view, your belief of the underlying effect. And then in the end it comes down to still making somewhat of an active choice that at some point the confidence just isn't there enough to justify taking risk in a strategy, as opposed to maybe other exposures that still look attractive. Yeah, so the notion of outcome-oriented, of course, is one that interests many people, perhaps because of the rather underwhelming performance of some of the strategies and funds that use systematic techniques or alternative risk premia as a label. And a lot of it, in my opinion, has to do with setting realistic expectations, both with regards of what can be achieved, risk-adjusted returns, as well as with regards to tail risk. So when I think about outcome-oriented investing, I very much think about what should an individual strategy achieve and what should the portfolio construction achieve. So popular techniques like risk parity work very well, but they are unclear about what they are actually trying to achieve in terms of an outcome for a client. I cannot explain to somebody who doesn't know about marginal contributions to risk what risk parity really is, but I can explain to somebody that what I'm looking for is many independent drivers of returns that help me control my tail risk and help me target a very specific risk-adjusted return with the investment universe that we have available. And often that means that what is realistic is a much smaller Sharpe ratio than what you would see in a back-tested environment where all the strategies deliver very high risk-adjusted returns and where perhaps the correlations were milder than you might expect them to be under normal circumstances. Yeah, so the question about evaluating a backtest is a very good one, because often what is taken from the backtest is that it describes in its entirety all the information that's available about a certain strategy. So if I had to judge what a strategy can achieve going forward, should I really just be looking at what it has done in the past, when maybe the regime was different, maybe the market environment was different, maybe there were certain windfall gains which are unlikely to be repeated. So I think backtesting should be viewed as one of the tools that a systematic investor should use, but it's by no means the only one. As important is understanding the sensitivity to the market environment and the sensitivity to perhaps forces that might change over time. So again, this notion of building up the right initial belief about what can really be achieved and then comparing it to what the backtest is telling me. So I would never look at a backtested strategy with a Sharpe ratio of higher than 1 and expect that to be repeated in the future. Yeah, so dimensionality is a very interesting concept that initially we developed as a risk analytic to somehow answer the question that clients were asking about funds that were deploying 10, 20, 30 different strategies, but somehow they wanted to know how many independent drivers really underlie your performance, or are they just 20 different ways of expressing the same view on the Fed? So we used it as a risk analytic initially, and then we worked together with academia, in particular Edinburgh University over time, to operationalize a risk analytic into something that's more of a portfolio construction paradigm that is very much related to the outcomes. So working on trying to understand how this notion of dimensionality relates to Sharpe ratios on the fund, how it relates to tail risk on the fund, so making all these direct connections, which perhaps other concepts of portfolio diversification haven't really been able to establish. So I think models will always fail at some point in time. One useful philosophy is go with the paradigm of all models are wrong, but some of them are useful. So I think in particular when it comes to risk management and when it comes to stress testing, it is at that point in time where a truly model-driven approach won't give you the full picture. So we've always operated with defining very thematic scenarios, ones that we can define in conjunction with strategists and economists to think about what is extreme but somehow economically plausible. It doesn't mean that it has happened in the past. It doesn't mean that we are forecasting or predicting anything to happen. We are just saying there's a logical sequence of events that could lead to a particular market outcome, and we should test the portfolio under these conditions, which might involve very different correlation structures, and it might involve market moves which perhaps in these combinations we haven't seen before. So it's very different to a stress test in a bank, which is very much based on Greeks and deltas and trying to move individual market components. This is a very thematic approach to trying to understand what really are the types of market environments that are painful for these portfolios. And I think in that instance, I would say that most models fail, and we do need the support of the more qualitative input that we get from economists and strategists. Well, one of the interesting aspects of this conference here is that it very much combines very quantitative strategy construction with the question of risk management. I always think that one cannot be thought about without the other. I think the best strategy designers are those that maybe start from a risk management perspective. So specifically calling this event risk management related kind of prompts everyone to think about risk management as an integral part rather than an ex post observation that's being done by a third party.